Okay, so we are now looking at capital budgeting, which is also called the investment appraisal technique. So in capital budgeting, we are trying by all means to evaluate the project. Is it worthwhile for an individual to invest in a project? So that is what capital budgeting is all about. It is also called the project evaluation technique. So here we consider a number of techniques that we use to evaluate projects. So investment projects are appraised using a combination of a number of techniques. And these techniques, the first aspect of the techniques that we look at is the NPV, which is the net present value of a project. And then also look at the payback period of a project. So in short, we're just talking about how long it takes for an individual to recover the exact amount that was invested in the project, which is a payback period. Then also look at the internal rate of return of a project. Then we get into the accounting rate of return. And then the last one is the profitability index. So there are 5 techniques that we use to evaluate projects. So when we start with, we can get down to the first one, which is the net present value. So this one is just the sum of the present values of all cash inflows, then minus the initial investment in the project. So under this one, we accept the project if the NPV is actually greater than 0. Okay, so under the NPV, and under this one, we accept the project when NPV is greater than 0. So under NPV, we say our NPV, if the NPV is greater than 0, then you actually accept project. Otherwise, you are supposed to reject the project. So here we accept the project if NPV is greater than 0. So that's the second aspect of the first aspect of project evaluation techniques. So we get into the second one, which is the payback period. Okay, so payback period, we are just talking about the time taken to recover the exact amount invested in the project. But before even we get down to the payback period, we have to talk about the advantages and disadvantages of the NPV, which is the net present value. So the first advantage is that this one takes into account the time value of money. That's the first aspect there. So NPV, net present value, considers the time value of money. In the second aspect of looking at the advantages, we will also use as the cash flow. Okay, so this is the cash flow as they come. So original cash flows as they come, that's the second one. Of course, this one does not account for profit, just the cash flows as they come, the original cash flows. And also takes account of all relevant cash flows of the project and the project life. So meaning the project can take 5 years, it can take 2 years, 3 years. When you invest in any building, or maybe you can invest in transport business. So you look at how long it takes for you for the project's life cycle. Okay, so you look at the relevant cash flows that are there, but you discount them. The other aspect of looking at the advantages can take account of the conventional and non-conventional cash flows. But the most important part of the advantages here of the net present value is the aspect of the time value of money. This one, because we use the present value and the discount values. Because looking at the time value of money that you lent, where we're going to look at the present values of the cash flows.
Bring the charger, my darling. My blankets, my darling. Mama, come and pick the books, put them nicely.
Okay. So that is what. Then we can now get into the disadvantage of net present value, which is the NPV. Okay, so the project cash flows may be difficult to estimate. And especially that we use the discount factor tables, it's not very easy to compute. Then again, the other disadvantage here, accepting all projects with a positive NPV only possible in a perfect capital market. And then this one does not account for profits. So the other disadvantage is that this one does not account for profit because it only uses the original cash flows as they come. So this one, we simply say this one has a disadvantage that this one does not account for profit, does not consider profit. So this one does not account for profit. That's another disadvantage. Okay. Then we can look at the other technique. Okay, so the other technique that we're going to look at is the payback period. So these are some of the disadvantages of NPV. Okay, so the cost of capital may change over project life. So cost of capital is the value that we use to discount projects to find the present value of projects. Okay, so we can get now to the second component or the second technique as we look at the capital budgeting, which is the payback period. Okay, so payback period, we are looking at just the exact time that is needed for you to, or for an individual to recover an investor to recover the exact amount that was invested in the project. So if you invested 70,000 kwacha in a project, how many years is that going to take for you as an investor to recover the amount that was invested in the project? That is it under the payback period. Okay, so now looking at the example, the first example, considering the net present value, the NPV. The example here, we can look at both this example question 1, then we are going also to look at the question that came in a test. So here we have a firm expects the following streams of cash flows from its project of $500,000 per annum for 5 years. So the project initial cost was the 1 million. So as an investor, you have invested in the project, you have pumped in money in this project, 1 million kwacha. Then per year, you are recovering $500,000 per year. And then that is for 5 years. And the cost of capital is 10%. So we need now to determine whether the company should take this project or not using the NPV. So we have year 1, that is year 0, we have invested 1 million here. And then the cost of capital we are using is 10%. So the present value, we can use 1 plus R to the power negative n. So this 1 plus R to the power negative n. This is the discount factor to use when finding the present values. Okay, so for year 0, we have actually invested a 1 million kwacha. Then we are recovering 500,000 per annum for 5 years. So we have recovered 500 here. Year 1, we have recovered this amount. Then we have recovered the same amount, 500,000. Year 2, year 3, we have also recovered 500,000. Year 4, we have recovered the same amount. Year 5, we have also recovered the same amount. So these discount factors are obtained using the 10% cost of capital. So using a calculator, we can compute for year 0, you are just simply saying is 1 plus R to the power negative 0. We are saying negative 0 here because this is at the time that we are making an investment in this project. So we are assuming the year is 0. Year 0, this is when you're making an investment. We are in this project, we're investing in this project 1 million. So we have recovered in year 1, we have gotten back the 500,000. Year 2, we have also gotten back 500,000. So now finding the net present value, we have to find using the cost of capital here. So this is where this one came from, using the present value factor table, the 1 plus r to the power negative n. So we've got year one, we have gotten this amount. The discount factor is, excuse me, the discount factor is 0.9091. So we can multiply this amount, multiply the discount factors by the cash flows. We are getting the present value, which is equal to 454,550. That is on year one. Year one, year two, we are also getting the 500,000 multiplied by the discount factor. This one, then we are getting the 413,200. Year three, we are also multiplying this amount by the discount factor to get the present value of 375,650. Similarly, we are getting down to year four. We are also multiplying the 500,000 by the discount factor of 0.6830. We are getting the present value of 341,500. Year five, we are also multiplying the 500,000 by 0.6209. We are getting the 310,450. Are there any questions so far on this one?
Yes, I have a question. I'm not clear how you're getting the discount value. How are you getting it?
Okay. So the discount factors, we are using the cost of capital to get the discount factor. So if you have a calculator, or you can even use the tables here, I'll explain both ways. So here, the cost of capital is 10%. And if it is year one, the zero discount factor is 0.901 from the tables here, from the present value tables. Okay, so we have this one for year one. This is where the discount factor came from, the 0.909 for year one. Okay, so here you can actually confirm it. This is where the 0.9091 came from. But of course, if you have a calculator, you can just compute manually. Okay, you can just simply say the cost of capital here is 10%. So we're using this formula here, which is 1 plus r to the power negative n. So negative n represents the number of years. So here we can say 1 plus the 0.1. If we're going to compute manually, 1 plus 0.1, then to the power negative n. So meaning here we're going to have 1.1 to the power negative n. So if it is a year one, you put the power negative 1. So if you have a calculator, you compute the 1.1 to the power negative 1. It will give you the 0.9091. That is when they round off to 4 decimal places. Have I answered the question?
Sure.
Yes.
Thanks.
So what you need to do is you need to get a calculator in case the tables are not given. In financial tables, these ones. So these are the present value factor tables that you can use. So for year one or period one, you can get the 0.909. When you're using the 3 decimal places, so you can go to year two or period 2, you get this one, the 0.826. Year 3, you can get the 0.751, getting down there to the number of years that are given in the question. Okay, so here we have this question here where So he was still looking at the net present value. So this is where the discount factors came from. So we can use the formula, this one, so we can still use the tables. And then when you multiply the discount factors by the cash flows, then you are getting the present values. So this is how these present values came about. Now, when getting the NPV, the net present value, you add these present values, the total of these present values, you add these ones, the present values minus the initial investment in the project, so that you find out if it is worthwhile. So you can add these ones here, from this one up to here, the total of these ones minus the initial investment in the project of 1 million. Then you are going to find the 895,350. So they found the 500,000 from here up to year 5. These figures, they represent the cash flows that you are able to obtain from the project after making an initial investment in the project of 1 million. Then we are getting these present values that you're supposed to sum up from here up to year 5, then subtract the amount that you invested in the project. So accept the project if the NPV is greater than 0, otherwise reject the project. Like I mentioned here, if NPV is greater than 0, you accept the project, otherwise you reject the project. So here we have NPV of 895,350. So if we are to go to the second component of the project evaluation techniques, where we are looking at the payback period, from the information that we have been given here, what is going to happen is that after an investor has made an investment of 1 million in a project, and then is recovering the streams of 500,000 per year, meaning that for this project, excuse me, for this project, the payback period is exactly 2 years. Because year 1, you have recovered the 500,000. This is year 1. Year 2, you have also recovered 500,000 when you have made an investment of 1 million. So the payback period is exactly 2 years. You would have recovered your 1 million that you invested in the project. So for the payback period, so this is it, payback. So we have a payback here. Our payback is 2 years, exactly 2 years. So we will get to the question. Now, before getting down to the okay, so here we can now look at, so this payback period, it just indicates the the time taken to recover the exact amount that was invested in the project. So the shorter payback, the better, because you would have recovered your money in the shortest possible time, which is you are going to be, we're trying by all means to avoid the risk of losing your money. Okay, so if you have a payback of 1 year, so among the projects that you were supposed to invest in, the one that has the smallest or shortest payback is the project that you should invest in. So the payback method measures the length of time the project takes to pay back the initial cost of the project. So it's just the time taken to recover the initial investment in the project. So the period is counted as a full year where the entire cash flow is used to pay back towards the capital. Of course, we can get into the advantages of the payback period. That's the second project evaluation technique on capital budgeting. So now the advantages of payback, it's simple to understand and calculate. And then it is also considered cash flows as they come. Okay, let's see, it's the major advantage. So the disadvantage is that this one does not consider the time value of money. It ignores the time value, the timings of cash flows, meaning that you don't use the tables for the payback period unless you are looking at the discounted payback period. When you're when you're using the discounted payback period, it's that's the method we only use it to discount. Otherwise, the normal payback does not consider the time value of money. But if in an exam they say calculate the discounted payback, then we are supposed to discount the cash flows for the discounted payback. So advantage is very easy to calculate and understand. Okay, so the first aspect here, we are saying it's simple concept to understand. And then it's also easy to calculate. Then it also uses cash flows as they come. Okay, so under the advantages of the payback period, then getting to the disadvantages of payback, it ignores the time value of money. Okay, and then it does not also account for profit. It does not account for profits. Okay, so some of the advantages are given here. So, and then it ignores cash flows after the payback period, because as an investor, when you have invested in a building or in a transport business, and then you realize that you invested a 100 million, then you to recover it, you stop accounting for the other cash flows as they come, because you would have just decided to say, what more my money, I've already recovered my money. So you ignore the timings of cash flows, other cash flows as they come, because you would have recovered your money. So it will not be of any value. So this one ignores the time value of money, the concept of time value of money it ignores, and it ignores other cash flows after payback period. So you are talking about other cash flows. So other cash flows after payback period are ignored, because you would have just interested in recovering how much money you pumped in the project. So it is meaningless for the other cash flows coming, you just ignore them. So that is it. Now we may have a project, okay, or we can get back to the test. Okay, so if we go to this test that came, okay, we have question 1. So we have 3 projects that are there. Okay, so the question 1, you are a senior manager at this aircraft and have been authorized to spend up to 400,000 for projects. The 3 projects you are considering are the following features. So project A, the initial investment was 280,000 kwacha. Then cash flow year 1 will be 190,000. After you have invested 280,000 in project A, this money you are likely to lose, because that's a risk taking. Now, after investing in the project A, we have the cash flow year 1 is 190,000. Then in year 2, it will comes to 170,000. The planned expansion program and such, the required rate of return here is 10.3%. That's one project A. Then project B, the initial investment is 390,000. That's how much you have invested in project B. Then cash flow year 1 is 270,000. While in year 2, it will reduce to 240,000 kwacha. And then the cost of capital or required rate of return is 20.4%. Project number C, the initial investment is 230,000. Then year 1 cash flow is 160,000 kwacha, and then it will increase to in year 2 to 190,000, and then the required rate of return is 15.7%. So each of these projects has different cost of capital or required rate of return. For that is for A 10.3, B 20.4. So we can still get these ones from the tables, or by just simply using the formula, which is 1 plus r to the power negative n. We can use this formula here to find the present value factor. So you have to use this one. N represents the number of years. So now, they're saying, please offer your recommendations, back your analysis with using the following methods: the payback period, the first one. So for each project, we're supposed to find the payback period. What's the payback period for project A? What's the payback period for project B? So we can get down to the solutions here. So project A, initial investment, we are saying it is 280,000 kwacha. Then cash flow year one is 190,000 kwacha. This is how much money we are able to recover from project B. So that's, sorry, project A. So we're able to recover in year one, we're able to recover 190,000. Then year two, we're able to recover 170,000. So our payback period, we have recovered 190,000 in year one, but we need to recover the exact amount invested in the project. For project A, 280,000 kwacha. So year one, we have recovered just 190,000. So there's a difference here. Okay, so there's a difference here of, since we have recovered year one, we have recovered 190,000. So we are short for, we subtract, because we need to recover exact amount of 280,000. So we're going to say 280, then minus what we need to recover, because we need to recover the exact amount. We need to recover the 20,000. So we should subtract the 190,000. So we find the difference, what is remaining from how much we invested. So here, what is remaining is 90,000. So this 90,000, where are we going to recover it from? We're going to recover it from the other year. So we're going to recover this 90,000 from year two. So that's why we have a one here, which is it. We have recovered part of the money because we need to recover exact 280,000. So there's a difference of 90,000 that we can get from the 170,000. So in finding the payback period, so this is how we actually do it. So we have the 90,000, we can recover it from the other year, which is year two. So we are going to divide 90,000 divided by 170,000. So our payback period is approximately 1.53 years. So getting down to project B, project A, we have done the payback period. Then we get into project B. Project B, our initial investment in this project was 390,000 kwacha. But the one we have recovered the 270,000, meaning we can also say 390,000, then minus how much we have recovered year one, we've recovered the 270,000. So meaning that we have the shortage to recover the exact amount. We have a balance of 120,000. We subtract here. So we are getting 120,000. So where are we going to get this 120,000 from? We are going to get this 120,000 from year two. So year two, we are going to recover the 120,000 from the 240,000. This is where it's going to come from. So that's why we are dividing. Year one, we have recovered part of it because we have gotten the 270,000, but we need to recover the exact amount of 390,000. So meaning the balance of 120,000 is coming from the 240,000. So we are dividing here. So we are getting 1.5 years. So among the projects, the project that has the shortest payback period is the project that we can select based on the payback period. So we can now get into project C. So project C, our initial investment is 230,000. So year one, we've recovered 160,000, meaning that our balance will be 230,000 minus how much we've recovered. In year one, we've recovered 160,000. So after we've recovered 160,000, we need to know how much is remaining for us to recover the exact amount that we invested in the project. So we are having the balance of 70,000 because we need to recover the total amount of 230,000 kwacha. So the 70,000 kwacha is going to come from the 190,000 kwacha. So after dividing this one, so this one should be divided similarly, just to among all the projects, this one should be divided, then plus the 1 year. So we're getting 1.36 years. So based on the payback period, invest in project C with the shortest payback period. So project C is the one that has the shortest payback period. So that's a project that we need to select, because if you can check here, we have project A, the payback is 1.53 years. Then project B is exact 1.5 years. Then project C, we are talking about 1.368 years. So project C had the shortest payback period. The shorter the payback, the better, because you would have recovered your money in the shortest possible time. All right, then. So we can now get into the other part of it. So we'll do all these, the payback period, the internal rate of return, I'll explain it. But let's do the NPV, which I've already explained. So we can calculate the NPV for project A. So this one uses the time value of money, the discount factor tables. So here we can use it, the 1 plus r to the power negative n, or we can simply use the tables if the tables are given. So here, project A, the initial investment is 20,000. The cash flow year one is 190,000. And then the two cash flow is 170,000. The cost of capital, we're talking about 10.3%. So we can calculate the NPV for project A. So for project A, we have the outlay of 20,000. Then it is 10.3% as the cost of capital, 10.3%. So here we can use our present value factor, where we simply say 1 plus r to the power negative n. So we can substitute here this 10.3, we have it here. So if you substitute in the formula, we can get, we are getting 1.103 to the power negative 0. Okay, this is the time. It is year 0 because you are making an investment at the beginning of the year, at the beginning of the period, or beginning of the project. So the year is 0. So we're saying year 0, 1, and 2. Then we have the cash flows here. So the cash flow is 20,000. Then for this one, we have 190,000. Then cash flow year 2 is 170,000. So these are cash flows that are coming to our business after we have invested 20,000 in the project. So we can now multiply the discount factors by the cash flows to get the present values at the far end here. Then even this one, 190,000 multiplied by the discount factor for year 1 using calculators. This is 1.103. So this is 1.103. Then to the power negative 1. So we can get this one. So this is 1.103 using this. We substitute the R there, is that the R has been given in the question. Similarly, when you're getting down to cash flow for year 2, it's 1.103 to the power negative 2. So we're getting the discount factor, factor, DFC. You are getting the 0.8219. So you multiply these ones, you are getting the final, the present values here. So these two should be added. When you add these two, then we subtract the initial investment in the project. So based on the payback period, based on the present values, we are adding these ones, the discounted values. So adding these two, then we subtract the initial investment in the project for us to get a net present value. So this is just the sum of the present values of all cash flows minus the initial investment in the project. So it's the sum of the present values of the cash flows minus the initial investment in the project. So when adding the 172, 254, then plus 139, 723, we are getting the 311. So after adding these two, the total. So in short, we are simply saying our net present value is equal to the total of the present values, the 172, 254, and plus the 139, 723, we are getting the 311. So the total is 311, 977. Then minus the initial investment in the project was 280,000. Then we are going to find the net present value, the NPV. So NPV here is giving us 31,977. So there can be, depending on how many decimal places you are using, you can have a minor difference here. If you are using the 3 decimal places, or if you're not rounding off, you can find a minor difference, but the examiner will still consider it like that. So this is NPV for project A. Then we get into the other component here, where we are getting the NPV for project B. So NPV for project B, we have to go back. Our initial outlay was our investment in this project at year 0 was 390,000. And then our rate for this one was the 20.4%. So we can use this one, 20.4%. We can now use the present value factor, where we are looking at the same 1 plus R to the power negative N. We substitute the cost of capital, which is a 20.4%. So we are getting 1.204 to the power year 0. This is when we're making an investment in the project. So this one to the power negative 0, which is giving us 1. When multiplying these two, we are getting the present value.